Q4FY23 conference call of Shemaroo Entertainment Limited, hosted by Valorum Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. I now hand the conference over to Mr. Anuj Sonpal, CEO at Valorum Advisors. Thank you, and over to you, Mr. Sonpal.
Thank you. Good afternoon, everyone, and a very warm welcome to you all. My name is Anuj Sonpal from Valorum Advisors. We represent the investor relations of Shemaroo Entertainment Limited. On behalf of the company, I would like to thank you all for participating in the company's earnings call for the fourth quarter and financial year ending 2023. Before we begin, let me mention a short cautionary statement. Some of the statements made in today's earnings call may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Now, I would like to introduce you to the management participating with us in today's earnings call and hand it over to them for opening remarks. We have with us Mr. Hiren Gada, CEO, Mr. Argo Chakrabarty, Chief Operating Officer, and Mr. Amit Haria, Chief Financial Officer. Without any further delay, I request Mr. Amit Haria to start with his opening remarks. Thank you, and over to you, sir.
Thank you, Anuj, and good afternoon, everyone, and welcome to our earnings call for the fourth quarter and the financial year ended 2023. Let me first start off by giving some of the key financial highlights, after which our CEO, Mr. Hiren Gada, will give you some of the operational highlights. For Q4 FY23, the revenue from operations stood at INR 165 crores, which witnessed a growth of around 76% on YOY basis. EBITDA for the quarter was INR 17 crores, which has jumped by around 94% year-on-year basis. EBITDA margin stood at approximately 10%, and profit was reported at approximately 5 crore, which grew by around 137% YOY basis. For the financial year ended 2023, revenue from operations stood at 557 crores, representing a growth of around 46% YOY basis. EBITDA stood at INR 47 crores, which was up by around 32% YOY basis. EBITDA margin stood at approximately 8.5%, while net profit was 9.5 crores, which grew by 78% YOY basis. With regard to new initiatives in Q4, the expenses amounted to 1 CR, while for the year ended, it was INR 54 crores. And if you adjust this investment, the adjusted EBITDA from operations in Q4 and Q3 would have been approximately rupees 18 crores and 101 crores respectively. Let me now take you through the traditional media and digital media division highlights. Digital media revenues for the fourth quarter stood at 53 crores, which grew by around 15% YOY, while for the financial year ended, it was 224 crores, witnessing a growth of around 23% YOY. Traditional media revenues for the fourth quarter stood at around INR 111 crores, which grew by around 136% YOY, while for the financial year it stood at 333 crores, witnessing a growth of roughly 67% YOY. Now I would request our CEO, Mr. Hiren Gada, to brief you on the operational highlights for the period under review.
Thank you, Amit, and good afternoon, everyone. In Q4 FY23, the company delivered a strong revenue growth along with positive margins on the back of a moderate increase in ad spends in the industry, and also due to a lower base effect compared to the same quarter last year. In line with our strategic shift over the last few years of moving from a pure B2B company towards B2B2C and B2C, I'm happy to inform you that the contribution of B2C revenues as a percentage of total revenue has doubled in FY23 versus FY22, and now stands to contribute around one-third of the overall revenue. On the other update, Shemaroo Gujarati had quite an eventful quarter where we released around 14 new titles with content across movies, web series and plays, including original web series Goti Soda Season 3, which was well received by the audiences, and digital world premiere of movies Hey Kemcho London, Hu Iqbal and Hu Tari Jeet. The subscription-based platform was also launched by Batelco, Zain and STC in Bahrain as well. Our portfolio of YouTube channels has continued to perform extremely well, with Shemaroo Filmy Gaane being 21st most subscribed channel in the world with over 64 million subscribers. We launched full movie streaming service Southplex with Do in UAE and Video Box with Jawal in Palestine as well. In the broadcasting segment, both Shemaroo TV and Shemaroo Umang have been consistently among the top 5 free-to-air general entertainment channels. Shemaroo GEC channels now have a viewership share of around over 9% in the overall Hindi GEC genre today. Ratings of Shemaroo Marathi Bana remained steady during the last quarter. Lastly, we also expanded our DTH portfolio as well with the launch of a new DTH service, Telugu Classics, with classic movies, TV shows, biographies and songs on Tata Play in April 23. In conclusion, considering the external economic scenario, I am very proud and pleased with our overall performance in this financial year. We started on this journey of strategically changing the business strategy in 2019, and against all odds and against all headwinds that we have faced. Over the last few years, we have overcome many of these challenges without over-leveraging our balance sheet and successfully meeting our strategic goal of transforming or being on that path. And now we are extremely confident now, more so than ever, that the agility, strength and innovative business model, along with a very strong professionally run organization with freshly inducted talent from the media industry that we have built over the years, we will see the company's financial performance significantly outperforming in the coming years. However, as a result of external factors such as inflation, looming global recession, dampened consumer demand and slowdown of funding for new age advertisers, this coupled with continued investments in our B2C initiatives, we are keeping a cautious watch on balancing our growth as well as profitability aspirations in the coming quarters, as margins could face some pressure. With that, I open the floor for question and answer session.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity. Hereby, congratulations for the turnaround and for the healthy numbers. So, couple of questions from my side. One is, sir, with regards to new initiatives in this quarter, it is at the lowest end, just about around 1 crore.
Yeah.
So going ahead, and for the full year, the figure stands now at 54 crores compared to roughly 67 crores in the previous year. So how do we look at the new initiatives spent going ahead in this current year?
So we continue to invest in the broadcast venture with more channel launch plans. And Shemaroo is the other new initiative that is where the investment is going. And considering the overall scale that now we have achieved and the way forward on both these businesses, we are budgeting an investment of approximately 75 crores for the next financial year. And if you recall, last financial year, I had indicated that a lot of it would be front-ended, and we don't anticipate, which in a way has played out in a similar way. Of course, we had a slight challenge in Q3 due to the external environment of revenue versus operations. But yeah, this year we expect it to be this much, and I believe that the operations are adequately geared to fully fund the investments as we have been doing in last few years.
Sure. Am I missing something? Because generally what we have been doing is every quarter or for last few years when the new initiative expenses have been incurred, and you have been transparently giving the new initiative numbers. So if I exclude the new initiative in the current quarter, maybe I may be going wrong in trying to do it on a quarterly analysis. But what I find is adjusted for this, the operating margin for the current quarter is just about 10-11%, and in fact for the full year also, compared to 25-27% margins in last year, the operating margins adjusted for the new initiative comes to around 18%. So how do we look at this, sir?
See, on margin front, there are two things I would like to put on the margin front. One is that as the TV and broadcasting business revenue grows, the margin profile will kind of map more towards broadcaster margin profile, which is a relatively lower margin profile than what we may have had earlier, but of course in a far more capital efficient business model. Secondly, yes, some of the channels would be probably at a low break even or a low positive kind of a thing. So therefore, if you add to that, they are not seeking additional investment, but still the operating leverage on those channels have not yet kicked in.
Mm-hmm. Okay. So the margins could be higher as we move forward as the operating leverage kicks in for even the broadcasting business, or what could be the basic difference between the business if you can share those margins?
Sorry, I missed the question.
So what you are trying to say that as the broadcasting business revenues go up, you will see an operating leverage, and probably in this quarter there is a higher broadcasting business perspective which is affecting the margins, adjusted for new initiative burn.
So what you are saying directionally, that's how it should be. But there are two factors here which is linked to new investment. So one is new investment in existing channels in terms of new shows being launched. So with this I have explained earlier also that with every new show launch there is a new higher equilibrium that we kind of try and achieve at the next level. But in the there is a gestation period between that new show launch and translation into revenue normally. So we still will continue launching new shows. In fact, last month also we have launched one new show on Shemaroo called Shravani, and this so this is one aspect of that which we expect because of that. And second is that there will be more channel launches also as we go ahead. That it will be and what happens again in a new channel launch, by the time we start monetization, it's at least 3-4 months into the launch. So there is an expense, but the relevant cost is not, the revenue is not yet fixed in. So these are two factors, and of course, in the short term, we are seeing this whole, economic headwind also, which is affecting, and that again, as we had shared last quarter also, that the situation has not significantly improved from that. It's definitely been better than what it was in that Q3, but still where the operational business is versus where the revenue translation is, the external environment is definitely impacting that revenue translation. So that also is tempering the margin to that extent.
Sure. And just a question on the balance sheet items with regards to both inventories and receivables.
Yeah.
So we had mentioned in the previous quarter con calls, last quarter, our inventories should peak out somewhere around 700 crores. We have ended this current year with 735 crores, and receivables seems to be a bit on the higher side at about 125 crores. So how do we see both these numbers going ahead, sir?
So, while there are 2-3 ways to look at this. I mean, so inventory days has come down significantly thanks to the growth in the overall growth in the business that we have achieved. So we almost halved the inventory days. So that is one. More importantly, we don't expect the inventory to go up. In fact, we expect this year the inventory should. In fact, this is near peak, and we are anticipating fall in inventory or lowering of inventory going forward in next 2-3 years. This is near about the peak. So I maintain what we had shared last time. Receivables also, see the broadcast business has a 90 days receivable cycle, and that has definitely impact. So overall, if you see year to year, the receivables have actually gone up by 70 crores for the entire company. But thankfully, it's the overall growth. So the number of days has actually gone up only marginally from 53 to 60. So it is linked to the growth in turnover.
Mm-hmm. But do we see the inventory going down aggressively in next 3-4 quarters? Are we trying to work on that over an aggressive way?
Yeah, so we are working on a steady reduction of the inventory, and I expect quarter-on-quarter picture is very difficult to say, but if we look at it on an annual basis, I think we should be reasonably lower on the number.
Sure. And just a last one, if I could squeeze in with regards to new channels, if you could share some more details in terms of new channel launches in the current year. This Shemaroo Chumbak, which has been launched for kids. So, is this? If you could share some more details on this.
Well, this is still you can say in a test mode in terms of test signals and distribution and all of that. So we still haven't had a full-fledged launch of the channel, but yeah, we launched the test signal in April, and now we are in the process of launching this channel, and based on how the year goes, we look forward to probably adding at least one more channel to the bouquet.
So one more channel over and about this kids channel in the current year. Is that what you're saying?
Yes.
Okay, sure. Thank you so much, Hiren bhai. Wish you all the best. Thank you.
Thank you. Our next question is from the line of Mayank Babla from Enam AMC. Please go ahead.
Hi, thank you for taking my question. Am I audible?
Yeah. Can you be a little louder? It's little soft.
Yeah, is this better?
Yeah, it's better.
So my question was around the 75 crore investment you're saying in the new initiative. So how will this be funded? I mean, from internal accruals, or what is the strategy?
Internal accruals. Entirely internal accruals. In fact, if you see over the last 4 years of this change in the business model, we've invested about close to 175 crores, and out of that, more than 80% of it has been funded through internal accruals. And in fact, this year we anticipate 100% of that to be funded from internal accruals.
All right. Thank you. And my second question is around the free cash flow. What will be the free cash flow for the current quarter?
For the current quarter?
Yeah, for Q4, yeah.
Just a moment.
Amit doesn't have it handy here. I think we can take it offline.
Yeah, we can connect it offline.
Okay, sure. That's it from me, sir. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one or two per participant. Should you have a follow-up question, we would request you to rejoin the queue. Thank you. Our next question is from the line of Viraj Mehta from Equirus PMS. Please go ahead.
Yeah, hello, Hiren bhai. Congratulations. Hiren, a couple of questions. You had mentioned that Q4 debt of 300 odd crores will be peak debt. In light of slightly tough environment and the new investments which are higher than what probably were envisaged earlier, do you still stand by that this will be our peak debt and our debt will only go down from here?
I think we could be probably one quarter here or there. So maybe Q1, what we have, that may be the peak debt. But I don't see now, debt going up from these levels. In fact, this year actually we have targeted a lowering and repayment of the debt. So we definitely intend to close the financial year with a lowering of the debt.
Can you share what will be that number? Will that be 30, 40, 50 crores or lower?
We are, well, I mean, it's very difficult for me to put it, but yeah, it should be in the range of what numbers you are saying.
Right. And is it, just trying to understand the revenue trajectory. We are like at 165 crore quarterly revenue in a quarter which is not even our peak quarter. So we did not have a Diwali season or something. It is just on back of broadcasting channels ramping up and we getting our share, basically viewership converting into the share of advertisement in Q4. So would you say that would it be fair to say that this is non-peak season quarter which can only grow from here quarter on quarter over next 4 quarters as obviously we launch new channels over a period of next 4 quarters?
Yeah, Orgo will take the...
Viraj, this is Orgo here. I'll just take this question. Just help me clarify. Are you saying that this is a smaller quarter comparatively from this annual quarter basis?
Yeah. So generally what we have seen is that Shemaroo always has Q3, which is the biggest revenue, and Q4 generally is lower than Q3.
Yeah.
But this year that has not been the case because obviously I think your realization in both Umang and Shemaroo TV has gone up, which is kind of contributed to you doing better.
Yes.
So my point is this then sustainable basis? Is this number and we can only grow from here on quarter?
Got it. So one is, you are right. I think, and there are two parts to it. I mean, broadcast, yes. I mean, broadcast is ramping up, right? So in Q3 during festive time, Umang had just come up, 2-3 months, 3-4 months before that. So as the channels ramp up, your GRPs keep going up, and hence your ability to monetize and your pricing per GRP that we can get is obviously higher, and hence that is obviously ramping up. So that is one part of it, in which probably this quarter is higher than that. But also remember that we have a lot of syndication business also, right? So that syndication business can also be lumpy. It is not unlike broadcast, which is steady state. It will keep growing. This is seasonality and so on and so forth. We have a syndication business which is our old B2B business that has lumpiness in it. So there were also reasonable good deals which happened in this quarter, which has also contributed, and they are not small amounts. So while yes, you are right, from the traditional, the steady state B2C businesses, this revenue size will keep going up only. You are right. But at a quarter level, it also depends on what kind of syndication deals happen, because that can either be a kicker, or it can bring down the overall numbers depending on in what quarter a deal is getting signed and closed. Because that is not consistent, month on month, seasonal and all that. It depends on when deals get struck. So that angle is also there.
I would add one more part to that, Viraj, is that given now this overall change in the model, we are, and this is to be tested, we'll only know probably in FY24 more whether it holds true or not. But we feel that the sharp seasonality that we were probably seeing earlier may come off a little bit, and
Sure.
the normalization of the revenue trending may be happening more also. But yeah, you're right that the B2C part, there is a certain steadiness to that revenue.
Sure. Thank you so much. And in terms of Shemaroo, and that's my last question, you had mentioned that our whole target market is probably around 20 lakh, 25 lakh kind of subscription that we want to achieve. Are we on track to? I mean, are we seeing that kind of traction with so much new
content? That was the addressable market is what we had said. We are, of course, this is still a journey, and this is the addressable market. We don't know how much of that would actually convert, and
absolutely
A, convert, and B, how much of that we would be able to capture. But I would say that on overall metrics, Shemaroo has been on a fairly healthy state of affairs in general. Obviously, due to competitive reasons, we are not in a position still to share more details, but definitely we've taken a pole position in the Gujarati market without a doubt, and we have a very exciting lineup of content coming up over the next 3-4 months, which I think should help consolidate further the leadership position that we have already taken.
Right. And just one last thing. Are all the 3 channels on standalone basis break even, or Marathi Bana is still not break even?
I would refrain from commenting on that because it's ultimately a bouquet or portfolio that you.
So, Viraj, I mean, in the broadcast space, having been in a larger organization before also, I think it is always the bouquet which works. I mean, there will always be some ups and downs because you are, that's how you are targeting. That's how there will be some which you've got investment phase and so on and all that. But as a bouquet, we are looking, towards making the entire piece profitable. I mean, in standalone basis, and as Hiren said, it will be difficult to comment.
Thank you so much, and best of luck.
Thank you.
Thank you.
Thank you. Our next question is from the line of Dwanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon. So the first question is, so if I look at our trajectory on the money spent on new initiatives, I think, as somebody was mentioning, it's 67 crore this year, we are at 54 crore. And if I remember earlier conversations, we always indicated that we will invest in new initiatives, but the trajectory will go down. Now this year we are planning to do 75 crores. So has anything changed in terms of whether we are getting more aggressive in terms of new launches than what we earlier envisaged? Or is that the macroeconomic thing because of which the revenue projections that we were thinking earlier for FY24 has come down? Which one of them has contributed to this larger burn that we are envisaging in FY24?
So definitely it is the first one. I mean, we see more opportunities on the broadcast side and on Shemaroo side, and we feel that having created the platform and having gone through the whole initial phase and everything, I think it's only fair that we continue to aggressively press the pedal on that, because it will ultimately I think, it's a combination of creating a strategically important pole position in a business, as well as helping create scale.
Okay. So essentially, even by my question was that, so I think Argo also in one of the interviews mentioned that FY24 on broadcasting business, we wanted to be profitable. And I assume that goal remains, barring, of course, the new channel launches that you do in FY24. So does it mean that the two new channels plus Shemaroo will all put together contribute to kind of a number?
Yeah, and so see, as I said earlier also, and this, last couple of quarters we have discussed also, is that where we stand, we would be, break-even plus or whatever. But we will keep ramping up the programming investment even on the existing channels. So when we talk of the investment, it includes additional programming for the existing channels plus new channels on TV side, and then of course Shemaroo's trajectory. That's really what this additional investment is all about.
Okay, got it. The second question is, you mentioned that we have now 9% share in the GEC market, right? So and in all our conversations, the size that we're talking about is 8,000-9,000 crore, including Marathi Bana. So our rightful share in that pie is around 700-800 crore, even if you mark it down by such.
No, it wouldn't work that way. Yeah.
Doesn't work that way. Yeah. Okay. So I wanted to understand how does it work in terms of revenue translation.
Yeah.
So I think first, remember that this is viewership share. Okay. Viewership share does not correspond to a straight line conversion into value share.
Okay.
And secondly, this 9% viewership share is of Hindi GEC. That does not include Shemaroo, Marathi Bana, and not the Marathi space. It is the Hindi GEC market. And GEC market has both pay and free. So everything put together, we have had a 9% viewership share in the quarter 4. Right? That will never translate into 9% value share, because the pay market, the pay TV is largely in urban, where the GRPs are significantly more expensive. So what advertisers pay for urban GRPs are far higher than what they pay for rural and urban plus rural GRP. So hence it is not a direct conversion from volume to value.
Okay.
What we have quoted 9% is the viewership share, which is the volume.
Okay. Got it. And so, Argo, in terms of, so let's say if we want to maintain or increase our market share in terms of our content strategy, what are we doing to kind of, let's say, move from 9 to 11, 12%? And also tying in it with that, my observation is that most of the new show launches have been on the Umang, and Shemaroo, the new launch slate has been relatively lighter. So is there any strategic angle to this? Can you throw some light on this?
I think that's a fair question. Yes. Our objective is to keep on increasing our viewership share, and in both channels. So yes, you are right. Our show launches have been largely around Shemaroo Umang, which is a more female-oriented channel, and that's where our show launches have been, and that in the last the last 3 shows that we're talking about, last 4 shows actually have been all launched on Umang. Having said that, so 2 parts to your question. How do we increase viewership share? We keep increasing our original content contribution. So the more original content that we keep pumping in, with the right content, with the right consumer insight and reaching out to the right audiences, we hope to increase also. The viewership share will keep increasing with our increasing slate of original content in both the channels. And you are right, we have not had too many launches in Shemaroo TV. But that you will see it get corrected. I think in the next 3 to 4 months, we should see a few launches in Shemaroo TV also. Shemaroo TV, as you know, has a slightly different flavor from Shemaroo. It is more a micro-crime channel which targets the male audience mostly. And we have not had new launches there, but that is going to get, that is going to get addressed in the coming quarters.
Having said that, our first 2 regional launches were on Shemaroo TV only. It was then that we, focused on the Umang opportunity, because there is a, certain audience profile mix that we are targeting.
Sorry to interrupt. Mr. Dhanil Desai, may we request that you return to the question queue for follow-up questions, as there are several participants waiting for their turn. Thank you. Ladies and gentlemen, please limit your questions to 1 or 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. Our next question is from the line of Harshil Solanki from Equity Capital. Please go ahead.
Hello. Good afternoon, team. Thank you for taking my questions. I had 2 questions. First is, how many hours of original content have we achieved? It was to max out at 4.5 hours. So when are we expecting that to peak out?
Right now, we are at about 3.5 hours.
Correct. So between the 2 channels. So I think, Harshil, it is, it's a question of, one is, when will we have 4.5 hours of original content? I assume you are meaning between the 2 channels or standalone each channel, I don't know. I think as the year progresses, we should be, at least having close to 4 to 4.5 hours of original content on both the channels put together. But remember, original shows also mean replacement of the current shows. It is also not, it's not that all the shows will continue for the whole year and will keep adding. It is also a replacement churn, keeping the content fresh and alive. So by the end of the next 3 quarters, we should be at least in the range of 4.5 to 5 hours of original content between the 2 channels put together. I am not including Shemaroo Marathi Bana here, because that has its own trajectory, own separate plan.
Okay, got it. The next question is, any specific initiatives we are taking so that we can increase the monetization of our inventory? For example, we can leverage our content and offer it to production houses, or like some of our competitors are doing already.
See, monetization of the inventory has multiple aspects to it, Harshil. One is obviously your pre-FCT, the FCT that you sell. Is a function of the kind of ratings and the kind of viewership share that you have, which is also.
Sorry, I want to clarify, Harshil. Is this you are talking of our TV channel inventory or the company's content inventory?
Content inventory.
Oh, I'm sorry. I was responding on the TV channel.
Okay. Yeah, I thought as well.
Okay.
Yeah.
So I was talking about TV channel inventory. I mean, that also can be maximized through solutions and selling branded content, branded solutions and all that. That is one part of it. The other part of it is something which, we won't take that part in terms of the other.
So, see, I want to first clarify and dispel this myth of the fact that, what is the monetization of the inventory and, whether it's happening or not or what. In the last 3 financial years, which is FY21, 22 and 23, we have invested about 175 odd crores in new initiatives, out of which around 143 crores has been generated or invested out of internal accruals generation. Now, this internal accruals is cash flow generated only on this inventory itself. So, while we are, while we may not have seen the the P&L translation because of these new initiatives were being costed out or recognized as revenue expenses. But the fact is that this entire investment, the whole new business has been funded 80% odd funding has come out of the inventory, sale or monetization. Secondly, we are constantly looking at, revenue opportunities from time to time, and I'll just give you two examples here to kind of give you a sense of different directionally how things are, playing out. So we own perpetual rights to a movie called Disco Dancer. Okay, and right now there is a live musical live show going on Disco Dancer, which is again licensed by us from or for that purpose. So that is one example. Second is say this movie Jab We Met. So we released Jab We Met, re-released Jab We Met in theaters on the occasion of Valentine's Day, in tie-up with PVR, and it has done exceedingly well for the fact that it's been a re-release of a 15-year-old movie. So I'm just giving you two references which have happened in this quarter itself. So this is on a continuous basis. From time to time we are extremely actively looking at monetizing or in different ways trying to create revenue opportunities from our inventory.
Okay, got it. The next question is, how are the ad rates moving up with the increasing viewership share? If you can share at least the percentage terms.
Actually, the ad rates are moving in line with the market rates. I would refrain from calling what percentage growth and all that. And I think ad rates are a function of two things. One is obviously your GRPs and our own position in the market. Also, at the same time, it is dependent on the kind of demand in the market, right? At the end of the day, pricing is a function of how demand and supply plays out. So while, as Hiren said in his opening comment, in this quarter, the quarter 4, we saw slightly moderate improved spends on the ad market, and hence in terms of demand, and hence we were able to monetize it better. Going forward, it will all depend on what kind of demand is there in the market. And yes, as our GRPs are increasing, we are steadily increasing our ad rates. But it's more or less in line with what the market rates are for the Swedish space.
Thank you. Sorry to interrupt. Mr. Harshil, may we request that you return to the question queue for follow-up questions, as there are several participants waiting for their turn. Our next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. So my first question is regarding the outlook on the traditional syndication business. So what is the outlook, and can we go back to pre-COVID level of revenues?
No, I just want to say that actually this is a conscious decision to actually move away from that, or rather, I would say, reduce the dependence of that business on the overall business mix, and therefore consciously we have taken capital away from that and invested into these new initiatives which have now ramped up. So the syndication business is a more B2B trading kind of a business with a certain
The number you have dialed is currently busy. Please try later. Meanwhile,
Hello.
Sir, the line for the participant, there's disturbance from the line of the participant, so I've muted the line.
Okay. So yeah, so actually we consciously are not looking to grow that business back to the earlier levels.
Rishikesh Oza? The line for the participant has dropped. May I request the management that we'll move to the next participant?
Yeah. Please move.
Our next question is from the line of Hina from DAM Capital. Please go ahead.
Hello. Thank you for this opportunity. So, I was just...
Can you just speak up a little louder?
Yeah, sure. So, I was browsing through our presentation, and you also mentioned about the ad revenue still being subdued. I just wanted to understand, if I'm not wrong, most FMCG companies have recovered on margins as of Q4, and they are all positive on continuing or increasing their ad spends for the year. So why do we still feel that the next quarter would be subdued in terms of advertisement?
So, it's not that we are saying it is subdued, we are cautiously optimistic.
Okay.
It is, see, at the end of the day, remember, FMCG is though it's a large part of the
pie, the ad pie.
AdX pie. But there is also a set of new age advertisers who have been advertising very strongly in the past. And these are all the fintech and other companies, startups and so on and so forth, where the funding has dried up and hence there is a bit of a challenge in their advertising money there.
Sure.
So that is one part of it. And yes, while FMCG companies have posted reasonably good results, but one of the if you look at their results, one of the lines in which they have been a little bit cautious is on the A&M line. The outlook is there positive, but yet at the overall level, the environment is not as buoyant as one expected. Despite the results being so and so, but it is also because a lot of new age advertisers have really gone off the advertising space.
Sure. So just to follow up on this, how much would our split be between new age advertisement and FMCG? Like a rough percentage?
We would be, we are a U plus R FTA channel. So in our channels, the contributions of FMCG would be far higher. But the other players do contribute to a certain percentage of the ad revenues, but they also come at a higher price index. So it's also a question of the pricing index. The FMCGs are normally the price index of FMCGs is lower. So while they take a large chunk of the GRP, but their indexing on pricing is a little lower compared to that. It's a combination of both.
I would add one more part that on the digital media side, which are all the digital video platforms where we are there, the YouTube, Facebook, etc. There the startup ecosystem is
the new age, correct.
And definitely there has been a significant impact over there.
Okay. So in that sense, you would say that you'll be more cautious before,
The reason for that person is a holistic view on the whole thing. It's not just a TV business on a standalone basis. It's environment that we have.
Because we also have a pretty large YouTube and Facebook business.
Yeah, correct. And just one thing on inquiries, like, advertisement inquiries, are those back at least? Have those improved, like inquiries from advertisers?
Sorry,
inquiries?
Yeah. So, like, are advertisers back in the market, or even that hasn't happened? So, like, can we expect that Q2 things will be better or something like that?
So it will all depend on the overall, condition of the economy, how the recession pans out, what happens to the input. I mean, it's a function of various things, It's not just one or two issues. Advertisers are there in the market. It's not that they're not there. I mean, there is advertising in the market. But whether it will be as buoyant and as robust as we expected it to be is a question that we are not sure.
Okay. Thank you so much, sir. Thank you.
Thank you. Our next question is from the line of Jiten Parmar from Aurum Capital. Please go ahead.
Yeah, I joined the call a bit late, so I don't know whether my question has been answered. But just one question. Can you tell more about the YouTube channel, and what is the monetization on that? And I mean, if you can break up the revenues, if you give that.
Yeah. So overall, YouTube and digital video platforms, they contribute to about around 50 to 60% of the digital revenue. Telco is about 10%, and the remaining is Shemaroo and syndication combined. So that is the breakup for the digital business. And in terms of, as we just shared with the previous question, the digital video platforms have definitely seen an impact of the startup ecosystem funding winter, where many startups who have decided to kind of hold their spends, etc., or tone down their spend significantly, and that has impacted the CPMs and as in the ad rates and fill rates both. So that has been a challenge. One other fact also we would say is that, and this we have shared in last quarter also, is that there is a slight, I mean, if we look at it differently, there is a certain normalization of the post-COVID, upsurge of consumption that had happened. So, of course, we are all in a new normal, but we still are, probably we may see a couple of quarters of, so consumption-wise, it's actually been stagnant or even degrowing because, consumers are obviously going back to business or back to their normal lives or back to old habits or combination of all of that. So definitely that, therefore, next couple of quarters, YouTube outlook definitely continues to remain, I would say, tepid. And not just YouTube, digital video platforms as a whole, Facebook, YouTube, etc.
Okay, thanks. That's all I had. Thank you.
Thank you. Our next question is from the line of Nitin Sharma from MC Pro Research. Please go ahead.
Yeah, thanks for taking my question. Congrats on a good set of numbers. Two questions. What explains the increase in salaries? Are there any one-offs or is it the run rate going forward?
Increase in salary? Was that the question?
Yeah, employee costs.
Okay. So if you see, so something that I even stated in my opening remarks, that we have there has been a strong induction of talent, senior talent from the industry, and where a huge movement towards professionalization of the entire organization, including Orgo joined us in July. So, and subsequently there has been a series of new joinees at senior levels and at different levels rather also. And definitely that would have an impact on the employee cost. This is an investment, which goes hand in hand on the opportunity and business model that we are looking, because ultimately we are building a platform for continued growth, and we obviously need great talent to execute that and deliver the numbers. And that's really in different way, it's taking the organization to the next level or multiple next levels rather.
Understood. And second question is on that your traditional media business has transformed. So some breakup of the sub-segment would be helpful to understand the trajectory better, either on the Q4 basis or full year basis. Thanks.
Traditional media, right now I am not in a position to give you a breakup of that. Digital, I have given the breakup. And but as I have shared in my opening comments also, another way to look at it is that the B2C business that we embarked on is roughly now contributing 1/3 of the top line of the company in this or rather has contributed 1/3 in the entire FY23.
Thank you. May we request that you return to the question queue for follow-up questions, as there are several participants waiting for their turn. Thank you. Our next question is from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Sir, my next question is about digital. I think we've done reasonably well on the digital side. And if you look at the commentary of YouTube and other players, everybody had a very tepid, year and quarter. So can you break it up in terms of growth, if not absolute numbers? Which are the areas which has given us this growth, and how do we see that area like syndication, YouTube, Shemaroo in FY24?
Oh, you're saying in terms of the way forward. Okay. While we refrain from giving any forward-looking statement about our own performance, but I can overall share, the outlook. So I agree with you that YouTube and Facebook, the digital video platforms, are challenged, and growth has in the recent months we have seen that growth has been hard to come by, whether it's in views, whether it's in monetization, both. So we hope that this kind of situation, hopefully this should not last beyond 2 quarters. But it's a moving target, and we'll keep reviewing as we go along. On other fronts, we have a ramping up on so the opportunities that are coming up are more on syndication front, because a lot of markets are opening up for Indian content, and we have been striking deals across many international territories. So that is one opportunity that we are pursuing. In fact, we have been participating in various international markets and all of that. So that's one area. And of course, the other area is Shemaroo. So hopefully, as I shared earlier, we have a strong lineup on the Gujarati front. So we are looking forward for that also to continue on the growth trajectory. So yeah, I think broadly these are the growth drivers on the digital front.
Okay. And so with this kind of a burn, are we going to be break-even kind of that is the business plan that for FY24 also will kind of break even around that number, and profitability will start coming from FY25? Is that how we are looking at it?
Definitely, Shemaroo is not looking.
Not, I'm saying at a company level, not at a...
company level.
Yeah.
Company level, we are, even this year we have a positive bottom line.
Company level, Dhwanil, you're talking about digital?
No, I'm saying at company level. So let's say this, we have been around, 3-4 crore profit, and this quarter was, slightly better or much better. So I'm saying FY24, since we are investing more, around 75 crore, are we targeting similar profitability, or are we saying that increased scale will give us more revenue which will offset the 75 crore of new bond that we will do?
So again, I would like to refrain from forward-looking statement. But one overall thing I would like to say is that the major focus actually for us is going to be on cash flow and generating free cash flow so that we can reduce debt. I think that is going to be a very, very important, in fact, not going to be, it's already a very important internal, target or KPI that we are a key monitorable for us internally. So that is one very important thing. And as a result of that, overall, this thing is the reduction of the inventory. So balance sheet correction in sync with achieving, P&L scale, I think changes the whole picture completely from, that really is going to be a key focus. So at a higher scale and lower inventory, and lower debt, etc., all the ratios and everything changes significantly, and there is a free cash flow generation that we are definitely looking forward to during the year. So that, if you ask me, is a more important focus for us.
Okay. Thank you. Thanks a lot.
Thank you. Our next question is from the line of Harshil Solanki from Q4FY23 Capital. Please go ahead.
Hi. Thank you for the follow-up. I have two questions. So on the employee cost, is it maxed out, or are we still looking to hire more talent because the cost has gone up substantially? And when can we see that translating into revenues for us, the investment that we are doing in the employees?
So already we are seeing, 73% growth, or 45%.
Harshil, I think I don't know what you mean by when will we see the revenue increase. If you look at this quarter's numbers, compared to the market, I'm sure you're aware of how the media market has performed. We have grown about 76% this quarter on top line. I'm not saying that all of it is coming because of the new employees, but I think it's a host of everything put together in which everything has a role to play. So, yes, we would ideally like to grow even more, but I think this is a pretty strong revenue output which is already on the table.
And having said that, it is the growth that we have achieved is significantly higher than the growth in people cost. So, and to answer your other question, yes, the overall organizational team structure, we definitely hope a large part of it should fall in place in the coming months, and so to that extent, the cost definitely would go up to some extent, and the full year will see the full impact of that, because even many of the people that who have joined have probably joined in Q4 or end of Q3 or
so the full year impact will be there.
Yeah, that is definitely going to be there. But as I said, as what Argo said, that the growth on top line has been significantly more than that, and this is a base building for the next several levels of scale that we will.
Yeah, and actually, just to add to what Hiren said, we don't look at employee cost as an expense which needs to be netted off through revenue growth. This is an investment for the future of the company. So yes, revenue growth is important, but we don't link it to employee cost growth, because this is significantly changing the look and feel of the professional setup of the company. So that's how it is.
Okay, thank you. So last question is on the ROE side. When do we say it moving to 17-18%? Because current levels are not even covering the cost of capital. As a promoter, how do you look at this?
So as I said earlier, in fact, I said this in the opening statement itself, that we embarked on this whole business model transformation in 2019, and we happy to see that we have, in spite of all the odds that came in, COVID came in, everything happened, but still, within a reasonable time, we have actually been able to execute that and move to the next level. Now, obviously, having reached here, the opportunity to double down and scale up on a sustainable basis is significantly strong from here, and these investments are now to further cement that opportunity, and I have no doubt that as we go along, the translation on profitability, on return ratios, etc., will keep improving. And most importantly, as I said, shared earlier, cash flow, which is a major focus for us this year.
Understood. Yeah, that was it. Thanks a lot. Yes.
Thank you. Our next question is from the line of Manvardhan Bed from Laurel Advisory Services Private Limited. Please go ahead.
Good afternoon, sir. Thank you for the opportunity. So I noticed on some platforms, specifically Spotify, that for certain songs they've now started showing certain components of the video. And I noticed that obviously songs where you hold video rights and the music rights lie with some other licensee, on those they don't show that video. So I'm just curious as to, sort of your thoughts on that. Is there an opportunity for Shemaroo?
That's definitely an opportunity. I mean, any platform that is showcasing content ends up being an opportunity for us, and we explore it from time to time. In fact, we are at any point in time deeply engaged with each and every of these platforms to monetize and syndicate our content or license our content to them. So we do have some licensing arrangements with Spotify, but right now it's more. I'm not able to in a position to share specific details, but we definitely have deep engagement with every platform. So.
Including Spotify.
Yeah.
Spotify, Resso, and the others. So it is an opportunity, and we are at it, and we are continuously exploring that. But as you rightly said, any of these are opportunities for us.
Yeah.
So, just to take this question a little further, I mean, since we hold the video and the music right when the video is getting played, so if that were to come, then will we substitute the person who is just offering music on these platforms?
I don't think that will be. So it will depend on what the consumer is doing. If the consumer is probably only listening to the audio, then we don't have anything over there. But if he's seeing the video, then so I think it's more. I don't think there's a substitution here. It's an additional service that will be offered to the consumer, and it's a consumer's choice whether he wants to see the video or just.
Some consumers prefer to consume just the audio. Some consumers prefer to see the video along with the audio. So it depends on that. I mean, I don't think it's a substitution. I think these are all not fully incremental, but some percentage of it is definitely incremental.
Understood. Fair enough, sir. Right. Thank you.
Thank you. Our next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hi, sir. Actually, I was disconnected the last previous question. So, I heard you for your traditional syndicate business that you are moving away from the business and couldn't hear the other parts. So, could you repeat?
So, yeah, the point over here was simple that this last 4 years journey that we have done has been a overall focus to move the company into B2C business and not B2B. And to that extent, this the aggregation model that we had was something that we took capital away and invested into the B2C business. And with that B2C business, now we are not only have we scaled back to where we were, but we have put a solid growth path in place. And to that extent, the aggregation business will remain relatively low focus for us. It will not be zero focus. Plus, our own existing library licensing anyway we would be doing. But further trading or aggregation, because it's a lumpy business, has too many third-party dependencies, etc. Now we see the benefit of this B2C business significantly higher. That's really what I was trying to say.
Okay. So my second question is regarding the 75 crore investment that we are budgeting for the next year. So just I want to get a sense on how and when will this, investment or initiative go down, and when this will finally reflect in our, cash flows and our profits.
So, see, fundamentally the new initiatives where we have been investing continuously over the last few quarters are, one is the broadcast business and one is Shemaroo, the OTT platform. Now, OTT platform, is a strategic, future-oriented investment which is still at an industry level in a kind of a build-up phase, and we expect that this will probably couple of years for it to reach a critical mass of break even, and we need to keep investing till that. Our effort has been to stay as light and low on investments and still build a strong mind share and market share or revenue market share on that front, which I believe we have done it quite frugally, if you ask me. And on the other major investment is the broadcast business. Now, broadcast business investment has two aspects to it. So while fundamentally on a steady state basis the broadcast business breaks even where we are, but obviously the opportunity, given the huge market opportunity that broadcast offers and huge scaling opportunity that broadcast offers, there are two ways in which two areas in which we would be investing. So one is new channels, which I shared earlier during the call, and second is on existing channels, fresh programming or original programming, adding original programming slate. So these are the two areas in which the investment would happen. So typically each of these will have a certain cycle of breaking even, and all of these are incremental investments. They are not some fresh new initiative, new business foray.
Okay. And sir, regarding our previous, as you said, last 3 years we have invested close to around 140 crores on the new initiatives. Can you give a 175, I'm sorry. On 175 crores you have invested, can you give a breakup between our OTT and our broadcast business? How much we have invested in both the businesses?
Sorry, unfortunately I will not be in a position to do that. But indicatively what I can say is that initial phase the broadcast investment was significantly, in fact broadcast overall has been significantly higher, and more so in the initial phase because OTT investment has started only about 2 years back. So comparatively, and it was on a relatively low scale in the first year. So definitely a large part of that investment has been in the broadcast business. But I am not in a position to give you a breakup.
And we will also be keeping the burn in our OTT business also
controlled one, yeah.
Okay. And sir, my third question is regarding the channels. So for which channels have we achieved the break-even level?
I guess you missed the call, the discussion in between. So we will not be able to share that. At a portfolio level, it's breaking even, but individual channel level I cannot share with you.
Okay, no problem. So my just last question, I just wanted to understand with the broadcasting we are ramping up with and all the investment we have made and we are making more incremental investment, any sense on what kind of revenue size are we looking down like 3, 4, 5 years? What kind of revenue size are we looking at?
Basically, it will be very difficult to put a revenue size. It's a question of what percentage of viewership is. We are chasing viewership share. Okay, right now we are at 9%. We are looking at options how we can make it 10 and going forward 11, 12. Revenue is a function of various things. It's obviously a function of your shares. It's a function of the ad market. It's a function of What is the kind of creativity that you can bring around in your selling process? It's a lot of things. Issue is share of viewership and how can we make the entire piece profitable. I think that is what the goal is. Revenues will be an outcome of various other things, and I will not be able to put a number to it.
Okay, no problem, sir. That's okay. That was helpful. Thank you very much.
Thank you. That was the last question of our question and answer session for today. I now hand the conference over to Mr. Hiren Gada from Shemaroo Entertainment Limited for closing comments. Over to you, sir.
Thank you everyone for joining, and looking forward to seeing you all in the next quarter. Thank you.
Thank you. On behalf of Shemaroo Entertainment Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.